When traders speak about the final shakeout, they often think of it as some rare, dramatic event that only happens on the biggest charts or the most volatile markets. But in truth, the final shakeout is simply the last decisive test of weakness before a genuine markup begins. It's the final point where smart money examines the market, absorbs the remaining supply, and checks whether sellers are still strong enough to slow them down. It is subtle, it is deliberate, and it happens more often than people realize. The real challenge is not spotting the move itself, it's understanding the intention behind it. Have you ever seen price drop suddenly, hit a low, and then reverse sharply, leaving you wondering why you exited just moments before the move began? The final shakeout is not a random dip. It's not a mistake. It's not a breakdown that didn't work. It is the final attempt to remove weak holders, trigger stop losses, and force emotional selling before the true markup begins. Smart money does this because they want to move price upward with as little resistance as possible. Every seller who gets shaken out becomes one less obstacle on the way up. Every stop loss that gets hit becomes liquidity they can use to finalize their positions. The shakeout is the final clearing of the path, the final vacuum of supply before they begin lifting prices in a more orderly manner. If you've ever felt like the market intentionally waits for you to exit before it goes in your original direction, this pattern explains why. It's important to recognize that this final shakeout typically comes after a longer period of accumulation. Smart money accumulates quietly, carefully, absorbing supply without drawing attention. They keep price within a range, letting the public grow bored or frustrated. Traders begin to question the market's direction. Some abandon their positions out of fatigue. Others take impulsive trades simply because the range feels suffocating. And then, when that emotional tension reaches a breaking point, smart money pushes the price down, just enough to trigger stops, but not enough to break the deeper structure. This is the shakeout. Have you noticed how the market tends to make its biggest manipulative moves when most traders have already grown tired of waiting? In many cases, the shakeout takes the form of a spring. Price dips below the established support level, triggering stops and generating panic-based selling. Traders believe the range has broken. They assume a new downtrend is starting. Yet within a short time, price reverses sharply, returning back into the range as if the breakdown never happened. This quick return is the tell. It's the signature of smart money buying aggressively into the forced liquidity. The reversal is not accidental. It's a message. It says, the test is done. The supply is weak. The markup is near. But of course, most traders don't hear the message because they're too busy reacting to the initial drop. Volume during the final shakeout can reveal much. Often, you'll see a sudden spike in volume as stops are triggered and sellers rush out. But the key is the reaction after that spike. If the volume expands and price immediately rebounds, it means demand absorbed the supply. If the spread narrows and price refuses to continue downward, it shows that the selling pressure is exhausted. In my work, I've always emphasized, it's not the effort that matters, it's the result. A large effort downward with no continuation is almost always a clue that someone with strong hands is absorbing the move. Have you ever questioned why a heavy, volume candle sometimes results in almost no follow-through? Another sign of the shakeout is the behavior of traders inside the range. Before the shakeout, price often tightens. Volatility shrinks. Volume dries up. The market feels like it's holding its breath. This tightening is not random. It's the sign that supply has already weakened. Smart money wants to ensure that the last pockets of supply are flushed out. The shakeout is not just a move. It is the final confirmation of readiness. When supply becomes thin and fragile, the market becomes highly sensitive to a forced push. That push is what completes the process. And once the test shows no significant selling remains, smart money begins preparing for the markup. A trader with a wealth building mindset begins to recognize that these patterns are not tricks designed to harm them. They are tools for understanding the market's true condition. The shakeout teaches patience. It teaches discipline. It teaches that the market's deepest opportunities often hide in moves that feel uncomfortable, even frightening. The ones who chase strength rarely catch the beginning of a markup. The ones who observe weakness, understand its purpose, and wait for the confirmation often see the move from the ground floor. The shakeout marks the transition from uncertainty to clarity, from testing to movement, from accumulation to expansion. It is essential to understand that the shakeout is not always dramatic. Sometimes it is a small dip, a brief wick below support, a quick flush that lasts minutes instead of hours. The intensity does not define the pattern, the intention does. Smart money only needs enough movement to test supply. They do not want to damage structure, they simply want to confirm that the path upward is clear. A trader rushing to label every dip as a shakeout misunderstands the concept. The final shakeout is precise. It appears at the right place, at the right moment, after the right preparation. And that timing is what gives it meaning. Psychology plays a major role here. Many traders place their stops just below support, assuming that this protects them. Smart money knows exactly where these stops lie. They push price into that zone, triggering sell orders rapidly. The faster the stops are triggered, the easier it is for smart money to acquire large positions without pushing price upward prematurely. These forced sellers give professionals the liquidity they need. Once that liquidity is absorbed, price springs back, and the traders who exited in panic now chase the move upward, often entering at much worse prices. Have you ever wondered why the market always seems to hunt your stop? When the shakeout completes, the structure of the market changes. You may notice higher lows forming, stronger responses to demand zones, or an expansion in volume during upward moves. The tone shifts. Those clues matter. They tell you that smart money is done absorbing and is now ready to advance the market. The markup that follows is not random. It is the natural release of pressure after accumulation and testing. But identifying this shift requires patience, observation, and the ability to stay calm when the market intentionally tries to unsettle you. The shakeout is not just a pattern. It is a lesson in timing, emotion, structure, and intention. It teaches traders to study what the market is doing rather than how it makes them feel. It shows that the most powerful moves often begin where most traders give up. When we say the final shakeout clears, remaining weak sellers before markup, we're describing one of the most essential mechanics that makes a true bullish move possible. A market cannot rise smoothly if too many sellers remain in the way. It cannot begin a genuine markup if supply is still sitting beneath the surface, waiting to be released at the slightest sign of upward pressure. The role of the final shakeout is to flush that remaining supply. Those final weak hands, those emotional holders, those stop-loss clusters that would otherwise disrupt the next phase of the trend. Without that clearing, the markup would struggle, stall, or fail altogether. Have you ever wondered why some rallies take off effortlessly, while others die out almost instantly? The final shakeout usually comes after smart money has spent considerable time accumulating. They have already absorbed much of the supply during earlier phases of the range. They have tested minor lows, observed small reactions, and monitored how sellers behave. Over time, the supply weakens, but it doesn't disappear entirely. There are still traders who hold positions nervously. There are still stops stacked beneath support levels. There are still late sellers waiting to offload positions, and smart money knows that if they push price upward without removing these obstacles, the move will attract immediate selling pressure. So they create one final downward push, a controlled decline, designed not to break the market, but to clean out the remaining resistance from below. This downward push, the shakeout, is not a genuine breakdown. It is engineered with precision. The goal is not to send the market into a bearish trend. The goal is to make the market look weak, just long enough for the last group of sellers to surrender. Smart money triggers this move with deliberate timing. They push price below the obvious support because they know that is where most traders place their stops. Retail psychology is predictable. Traders hide stops just below structure, believing it offers safety. But that very behavior makes those pockets of liquidity irresistible to smart money. By pushing price below support, they activate those stops, forcing a wave of selling. and this forced selling becomes fuel for smart money to buy without visibly moving the market upward. Once these weak sellers are flushed out, something interesting happens. The market snaps back. The recovery reveals the truth. It shows that the breakdown lacked genuine selling interest beyond the stop-loss cascade. The moment those stops are triggered, supply often dries up. Traders who panicked out now regret their exit. Traders who tried to short the breakdown find themselves trapped. And smart money, having absorbed the last available supply, allows the price to rebound. This sharp return is the footprint of strong hands taking control. Have you ever observed price make a dramatic dip only to reverse so fast that it leaves you confused about what just happened? When weak sellers are cleared, the path upward becomes noticeably smoother. The markup phase that follows a proper shakeout often moves with clarity and momentum. Why? Because supply has been neutralized. Without leftover sellers eager to exit, the market faces much less downward pressure. Every new buyer who enters contributes positively to the move, instead of being countered by anxious sellers unloading positions. The absence of supply creates a vacuum, one that makes it easier for price to rise with relatively little effort. And this is one of the most important goals for smart money, to move price upward in an environment where resistance is minimal. Another crucial aspect of the shakeout is the psychological reset it creates. Traders who were waiting to buy at support are shaken out. Traders who were already long are pushed out by fear. Traders who pursued shorts become uncomfortable after the reversal. What remains is a cleaner chart, free of emotional baggage. The final shakeout resets the mindset of the crowd. It removes the traders who would have interfered with the markup by selling into strength or hesitating at key levels. It also creates doubt in the minds of those who exited. They begin second, guessing themselves. This doubt often fuels the early stages of the markup, as traders chase the move upward trying to correct the mistake they made during the shakeout. From a technical perspective, the final shakeout also provides smart money with a valuable piece of information confirmation. By pushing price into the zone where supplies SHULD appear, they test whether sellers truly remain. If heavy selling hits the market and overwhelms demand, the markup is not ready. But if the market absorbs the selling effortlessly and rebounds with strength, it confirms that supply has weakened sufficiently. This confirmation gives smart money the confidence to begin lifting the market. In other words, the shakeout is both a trap and a test. It traps weak traders while testing the underlying condition of the market. One of the most overlooked parts of this process is the role of volume. During the shakeout, volume often spikes, reflecting panic-based selling from retail traders. But professional buying hides within this volume. Strong hands absorb the selling efficiently, leaving very little downward progress despite the appearance of heavy activity. This imbalance, large effort but minimal downward result, reveals the dominance of demand. It tells you that the sellers involved are not strong sellers, but weak sellers being forced out. And it tells you that smart money is there to take the other side. The final shakeout also reinforces a wealth-building mindset. It teaches traders that true opportunities often appear wrapped in fear. It shows that the best positions are rarely comfortable at the moment they form. It reminds traders that the greatest markups begin when most participants are least willing to buy. A trader who learns to recognize the intention behind the shakeout begins to see fear as data, not danger. They understand that discomfort often signals the presence of smart money activity rather than the failure of a setup. As the shakeout concludes, the structure of the market becomes more supportive. Higher lows begin forming. Demand rises. Reactions weaken. Volume behaves differently. The tone of the chart shifts quietly but noticeably. When we talk about false breakdowns during the final shakeout exposing true underlying demand, we're pointing directly at one of the clearest signals that smart money leaves on the chart. A breakdown that looks convincing for a moment but fails to continue is not just a failed move. It is a window into the real condition of the market. It reveals whether sellers have any strength left or whether demand is quietly waiting beneath the surface. A false breakdown is the market's way of telling the attentive trader what you just saw was not genuine weakness. It was a test. Have you ever seen price break support cleanly, only to reverse so fast that the entire move feels suspicious? A false breakdown is not simply price dipping below support. It is the intention behind the dip that matters. Support levels attract attention. They gather stop losses, pending orders, emotional reactions, and predictable behavior. Smart money understands this, so they push price below support deliberately. The goal is not to start a bearish trend. The goal is to see how much selling pressure truly exists. If sellers are strong, if genuine supply sits below that level, price should continue downward. But when price breaks support and instead rebounds quickly, it proves something important. The selling pressure was not authentic. It was composed mostly of weak holders being forced out of their positions. Smart money then uses that liquidity to accumulate quietly without alerting the public. This structured dip below support is usually swift and sharp. It aims to trigger fear-based exits and stop losses. Traders believe the market has broken down and react emotionally. They sell because they fear further decline. They short because they anticipate a trend reversal. And in that moment of emotional volatility, smart money begins to absorb everything the crowd throws at the market. The false breakdown becomes the perfect environment for professionals to buy without causing visible upward pressure. Have you ever been stopped out by a breakdown, only to watch the market reverse instantly and move in the direction you originally expected? The magic of a false breakdown lies in its contradiction. It displays weakness on the surface, yet reveals strength beneath it. The chart shows a downward thrust, but the market's behavior shows resistance to continuing lower. This contradiction is meaningful. Weak markets fall easily. They accelerate downward when support breaks. They don't rebound sharply because demand is absent. But in markets where smart money is active, markets where accumulation has been occurring, price refuses to stay below support. It gets pulled back into the range almost as if someone is lifting it deliberately. Volume plays a key role in exposing this truth. During the false breakdown, you often see a surge in volume. Stops are triggered, sellers rush out, and short sellers enter aggressively. But volume alone isn't enough. The result of the volume is the real clue. When a heavy wave of selling fails to push price downward meaningfully, it means demand is absorbing the entire move. Strong hands are stepping in with confidence. They are buying everything the crowd is selling. And because this demand is hidden beneath the surface, the chart disguises it as weakness. This disguised strength is the essence of the shakeout. Another important detail is the speed of the recovery. A true breakdown gains momentum. A false breakdown collapses briefly, then snaps back fiercely. This rebound reveals the absence of real sellers. It exposes the fact that the move was engineered, not natural. The speed also signals urgency. Smart money is in a hurry to buy because they see an opportunity. Weak sellers are handing them positions at discounted prices, and professionals do not waste time in such moments. The market also leaves structural footprints around a false breakdown. Before the breakdown occurs, you often see tightening price action. Range compresses. Volatility drops. Volume decreases. The market becomes quiet. This quietness is not random. It shows supply drying up. And when supply is thin, a false breakdown becomes even more revealing. Smart money doesn't need to push price far, just enough to trigger stops. The rest of the move is powered by retail fear. Once that forced selling is absorbed, the recovery begins immediately, giving you a clear view of demand readiness. The false breakdown is as much a psychological event as it is a technical one. Retail traders are conditioned to see breakdowns as danger. They react emotionally. They exit positions in panic, trying to avoid further losses. They chase shorts because the move feels urgent. This emotional behavior creates predictable liquidity. And predictable liquidity is what smart money needs to finalize their accumulation. The false breakdown manipulates the public's mindset perfectly. Traders think they are avoiding risk, but in reality, they are delivering liquidity directly to the professionals who want to buy at the lowest possible price. This pattern also teaches traders a wealth building principle. Strength often hides inside weakness. A trader who learns to look beyond the surface begins to understand that the market's most powerful moves often begin with deceptive signals. The false breakdown is designed to look threatening because a threat flushes out weak participants. But to the patient observer, the breakdown is not a danger. It is a clue. It is evidence that smart money is active. It is proof that demand is present and waiting. And when demand absorbs the forced selling, the path for markup becomes clearer. Another crucial aspect is the position of the false breakdown within the larger structure. It almost always occurs near the end of an accumulation range. Smart money has already accumulated most of their position. Only a small amount of supply remains. The false breakdown is the final step, the last test. Once the test succeeds, once the market proves that sellers are exhausted, the professionals shift their focus from preparation to execution. They no longer need to suppress price. They can begin lifting it gently, allowing the markup to unfold. If you observe carefully, you'll notice that after a false breakdown, the market behaves differently. Pullbacks become shallow. Demand zones hold stronger. Volume begins supporting upward movement. The tone changes. Traders who were shaken out now chase the move. Those who shorted scramble to cover positions. All of this adds fuel to the new trend forming from the shakeout. A false breakdown is not just a price move. It is insight into the market's true character. It exposes the strength of demand hidden beneath fear. It shows you what the market wants to do, not what it pretends to do. When we say sharp recovery after the dip signals strong hands absorbing supply, we're pointing to one of the most reliable and revealing clues in the entire study of accumulation. The market can dip for many reasons. Panic selling, weak hands exiting, engineered pushes from smart money. But the way price recovers from that dip tells you everything about who is in control. A recovery that is slow, hesitant, and inconsistent usually means the market has not shifted from weakness to strength. But a recovery that snaps back with purpose, one that rejects lower prices quickly and refuses to stay beneath support, is a sign that strong hands have stepped in. They are absorbing the supply being thrown at the market and preventing it from falling further. Have you ever watched a chart fall aggressively, only to reverse with surprising force, leaving you wondering why you were shaken out right before the real move began? That sharp recovery is not random. Strong hands buy differently from the public. When the public buys, they chase strength, add into rising candles, and react emotionally. When strong hands buy, they accumulate quietly in down moves, and when they are ready to shift tone, their reaction is unmistakable. They absorb supply with confidence. They step in with firm demand that does not hesitate. As soon as weak sellers are flushed out, they allow price to rise, but not gradually. The recovery is strong, clean, and intentional because these operators want to ensure the market does not slip back into weakness. Their buying acts as a support mechanism. In the context of the final shakeout, this sharp recovery is the confirmation traders search for. The shakeout is designed to create fear, to trigger stop losses, and to force selling from weak participants. But once the test is complete, strong hands must step in to absorb the supply. The speed of that absorption becomes the signal that the market is transitioning from accumulation into markup. If the recovery is sluggish, it tells you that buyers are not sufficiently interested. The sellers might still be present, and any upward move could struggle. But when the dip is aggressively rejected, when demand steps in so fast that the breakdown appears to vanish, it is a sign that smart money has taken full control. Volume behavior also reflects this dynamic. During the dip, you usually see an increase in volume as stops are triggered and panic-based selling flows into the market. But once the recovery begins, volume tells a different story. You might see rising volume on the reversal candle. You might notice the spread widening to the upside. You might see a strong reaction with little selling pressure on the way up. These volume signals show that supply is being absorbed effortlessly. When strong hands buy heavily, they do not allow price to stay low for long. They lift price quickly because they know the liquidity window created by the shakeout is short-lived. Once the forced selling dries up, prices must be moved away from that zone before the market regains confidence. A sharp recovery also affects psychology in a profound way. Traders who were shaken out during the dip feel immediate regret. They begin questioning their decision and often attempt to chase the market back into the range. Traders who went short at the breakdown feel pressure as price rises sharply against them, forcing them to cover their shorts. This closing of short positions adds to the upward momentum, making the recovery even stronger. Strong hands understand these psychological reactions. They design the shakeout to create panic and then allow the recovery to punish those emotional decisions. The combination of forced selling and forced covering creates an inflection point, a surge of demand that marks the shift in control. Market structure also changes noticeably after a strong recovery. You may see price form higher lows, showing that buyers are now willing to support the market at elevated levels. Pullbacks become shallow, indicating that sellers are no longer confident or numerous. Areas that previously acted as resistance begin to soften and crumble. These subtle structural changes confirm that supply has weakened. When strong hands absorb the dip, they effectively reset the structure. The market starts to look more prepared for the markup phase that will follow. Another key detail is the decisiveness of the recovery. Strong hands do not allow lingering weakness. They often drive price back into the center of the range or above the breakdown point within a short period of time. This quick re-entry is incredibly meaningful. It shows that the dip was simply a test, not a genuine directional move. The speed of the return indicates conviction. If the breakdown had been real, sellers would have continued pushing price lower. The lack of follow-through exposes the weakness of the move. The subsequent rally exposes the strength of demand. This sharp recovery teaches traders an essential wealth building principle. Real strength is often revealed in moments of apparent weakness. A trader who understands this begins to reinterpret fear-based moves. Instead of reacting emotionally to breakdowns, they observe the market's response afterward. They wait for the recovery to reveal whether the dip was genuine selling or forced liquidity. This patience separates those who get shaken out from those who catch the markup early. Many traders fail because they react to the dip instead of waiting for the recovery. The professional mindset focuses on the reaction, not the first move. It's also important to recognize that sharp recoveries happen only when smart money desires higher prices. They do not waste their resources lifting price in weak markets. They only support the market aggressively when they have already accumulated enough positions and the shakeout has done its job. This makes the recovery one of the clearest signals a trader can rely on. It is not a promise of massive profits. It is an indication that supply is weak, demand is responding, and the structure is shifting toward strength. It shows that the market has been prepared for a markup. A trader observing this pattern must learn to read the behavior, not the emotion. The dip creates fear. The recovery reveals truth. Many traders exit at the bottom because they interpret the dip as danger. But those who wait to see the recovery understand that the market's real story is written in the reaction. When price jumps back quickly, breaking back into the range with force, it is telling you that strong hands have absorbed the final wave of supply. When we say the final shakeout typically appears at the end of an accumulation range, we're talking about a moment in market structure where smart money completes the last phase of their preparation. An accumulation range is never random. It is a deliberate zone where strong hands absorb supply over time while keeping price from running too far in either direction. But even after a long accumulation, there is usually still some remaining supply. Weak holders, emotional sellers, traders with tight stops, or those ready to exit at the slightest sign of trouble. The final shakeout clears all of this, and it almost always happens just before the true markup begins. Have you ever noticed how the strongest rallies seem to come only after the most discouraging final dip? Accumulation ranges form when smart money silently builds their positions. They buy quietly, not wanting to reveal their intentions. They keep price within a range because rapid upward movement would attract attention, which is the last thing they want during accumulation. Meanwhile, retail traders often become confused or bored during these phases. Some expect breakouts prematurely, others short the range repeatedly, and many oscillate between fear and frustration. Smart money uses this emotional drift to their advantage. The longer the range lasts, the more supply weakens. But even after a seemingly completed range, a small portion of supply often remains too stubborn to let price move freely upward. That's when the final shakeout becomes necessary. This shakeout usually takes place near the lower boundary of the range. Price has tested that level multiple times already, forming what appears to be solid support. Retail traders become comfortable with this support zone. They place their stops just below it because it seems like a safe zone. But this creates a trap. These clustered stops represent liquidity, exactly what smart money needs to finish accumulating without moving the market unintentionally. By pushing price below that support, smart money triggers all those stops at once. Sellers panic, stops activate, and liquidity floods into the market. This forced selling becomes the final opportunity for smart money to absorb supply at a discount. The timing of this shakeout is what makes it so powerful. Smart money doesn't perform it early in the range. They wait until most of the accumulation work has already been done. They wait until sellers are weak, volume has thinned, and the range has grown tight and quiet. When the market appears calm and stable, that's when the shakeout delivers maximum psychological impact.